April 2026 marks a turning point where global markets are no longer driven by growth, but by energy.
Oil prices are rising again, faster and stronger than most investors expected just weeks ago.
The recent market fluctuations suggest a significant shift in investor confidence, particularly in the tech sector.
This is not a demand surge. It is a supply shock.
One global event is now creating two completely different economic realities.
The United States absorbs the shock, while Europe feels it immediately.
The data clearly indicates a significant shift in consumer behavior, which is precisely why our updated strategy focuses on long-term sustainable growth.
Inflation, once expected to fade, is now returning with renewed and persistent force across the system.
The most significant factor in this analysis is the sudden spike right here, which correlates directly with a policy change in April.
This time, inflation is not temporary. It is embedding itself into the core of the global economy.
Energy is no longer just a cost variable. It is becoming the dominant force behind market direction.
They told me this city was impossible, that the dream was dead. But look around you. This is just the beginning.
Markets are beginning to reprice risk across equities, bonds, and currencies simultaneously. This is not short-term volatility, and this is the beginning of a structural transformation in global finance.
In the United States, the impact of rising energy prices is indirect, but steadily intensifying over time.
Good evening, and welcome to the Innovation Summit. We are thrilled to have you join us as we explore the possibilities of tomorrow.
Higher energy prices are quietly moving through corporate cost structures across multiple industries.
Inflation is now deeply embedded in services, making it far more persistent and difficult to reduce.
The numbers are deeply concerning. We are looking at a difficult quarter.
Despite rising costs, the U.S. economy continues to show resilience, supported by a still strong labor market.
They watching the moves, they feeling the vibe. This is the sound, the reason we thrive.
Equity markets remain stable, supported by strong earnings, but leadership is becoming increasingly concentrated.
Technology giants continue to lead the market, but their dominance is becoming increasingly concentrated and fragile.
As the latest figures indicate a significant shift in the market, we are seeing a stabilization period. This data confirms our previous analysis.
Earnings remain strong for now, but rising costs are beginning to compress profit margins across sectors. Bond yields are rising again, signaling that markets no longer expect interest rates to fall anytime soon.
Interest rates are no longer expected to decline, and they are now projected to remain higher for longer.
You entrusted me with this responsibility, and I assure you, I will not fail. The stakes are simply too high.
The system remains stable, but the cost of maintaining that stability is steadily increasing over time.
The labor market remains strong, continuing to support consumption and overall economic stability for now.
The recent market fluctuations indicate a significant shift in investor confidence. We are monitoring the situation closely as it develops.
Consumer spending is slowing gradually, not collapsing, but clearly losing momentum under rising costs.
Liquidity remains in the system, but financial conditions are becoming increasingly restrictive.
Credit markets are beginning to show early signs of stress, though not yet at a systemic level.
Why are you doing late?
Investors are beginning to question how long this delicate balance can be maintained.
Are you certain this is the only path forward?
Given the current market conditions, yes, it is the only viable option we have left.
We are live tonight with breaking news that has shocked the Capitol. Details are still emerging, but officials confirm the reports.